Hi everyone, welcome to In Books We Gist. This is a fun, cozy spot for us bookworms and gist lovers. If this is your first time here, please don't make it your last. And if you're a returning viewer, welcome back. I'm going to be talking to you about what I learned losing $1 million. Quick caveat, I didn't lose $1 million, but the author of the book that we're going to be talking about today, Mr. Jim Paul, he lost $1 million. It's said that it's good to learn from your mistakes, but it's even better to learn from someone else's mistakes. So today we have the opportunity, we have the privilege of learning from Mr. Paul so that we don't have to experience losses to the tune of $1 million before we can do better. So if you are someone who cares about your finances, if you're someone who cares about personal development, if you're someone who is actively involved in trading and investment, I think this is a good video to watch until the end. And even better, I recommend you actually read the book for yourself, because today this is somewhat of a long distance gist session. If you are a returning member, you know what that means. That means this is not a book I just read. It's been some months since I read this book, maybe about 6 months, maybe even more. So what I will be sharing with you are the most compelling, the most salient things, the ideas that stood out to me the most from reading the book. So I recommend that you pick up the book and fill in the missing pieces. I also have to say that I am not one who is a finance guru. I am not a financial advisor. Please, if you're seeking true financial advice, you have to go find a professional to get that from. This is In Books We Gist. We talk about ideas and the books that we're reading here. Without further ado, let's jump into it. So like I said, Mr. Jim Paul, he was active in the stock market. He used to be a trader. He traded in the 70s and 80s. And in this book, he divides it into two parts. In the part one, he talks to us about his rise, basically his upbringing. He tells us stories that happened in his childhood and how all these things led him to the position and the job that he had. And he was very good at his job. It climaxed at the point where he made this call. He made a call on the prices of a certain commodity, and he was right. He had encouraged his family members to take the position that he had, and he was right. And he he earned a lot of money to the tune of $1 million. Now, one of the things that stands out to me the most from part one is this idea that he shares with us, that at some point he started to believe that he was a little different from people. In fact, he started believing that he was probably better than a lot of people. The actual quote, it says, "I was beginning to think of myself as a little better than other people." Now, on the surface level, I don't think that there's anything necessarily wrong with this. I think it's possible for someone to come in and objectively analyze a situation and come to the conclusion that they are better than a lot of people, especially when you narrow the field of which you're doing this analysis. For example, if you put me and LeBron James in a room or on a basketball court and tell us to play basketball, I think it's fair and it wouldn't be ridiculous for him to come to the conclusion that he is better than me. And I think he mentions this because this alludes to what is to come. He mentions this because sometimes it's hard to be objective when you are in that mindset. Sometimes people personalize things that they should not personalize. And this is what gets you in trouble when you start to believe that you might be infallible. Things that happen to other people don't necessarily happen to you. Why? Because, like you said, you're better than most people, or you believe that. Towards the end of part one, he has made the right call. He has made a lot of money, and he's on this high because he was right. And he describes the high of making that much money. Let me read the quotes for you. He says, "The high from being right and making the money is unbelievable. Unlike any drug, you are impervious to all pain. It's literally like you expect God to call you any minute and ask you, 'Is it okay if I let the sun up?'" And after thinking about it for a minute, you probably say, "Yeah, go ahead." Can you imagine that high? Can you imagine how high you have to be to feel like this? I can. I don't think I've ever experienced anything like it. In fact, I know I haven't experienced anything like it. And to be quite honest with you, I don't know that I want to. Okay, because I think that's when you start getting into trouble. So moving on to part 2, he makes this call, he makes all this money, he feels like, he feels so good that he feels like God is probably going to have to call him at the end of the night to ask him for permission to let the sun up the next day. That's how high he's feeling. And soon after he's right, the price on this commodity starts to drop. It starts to drop and steadily drops. He doesn't believe that this is going to stay like this. He believes it's going to go back up. He tells all his friends to stay put, that the price is going to go up. Mind you, he's working for a firm. And as he stays there, the price continues to fall until finally the firm just fires him. And, he went through other things in his life, his personal life, and needless to say, he went into a deep depression. I mean, you can imagine being that high and coming down. The crash from that high has to be incredible. Fortunately for him, he tried to make the most of this situation. After he went through the motions and he started to think, what happened? How did I get to this point? He studied the market, he studied everybody that was making money, who were being successful, and he realized that there were so many ways to make money. There were multiple ways to skin a rat, sometimes opposing ways, and people were making money doing these different things, and people were teaching people how to make money, but nobody was really shining a light or making a point of teaching people how not to lose the money. After you make the money, what happens? What do you do at this point, And so that's what he went about to study for himself. And after he finished studying it, he decided to share with us. So in part 2, he now dives into the particulars about what you should do and what you shouldn't do to keep yourself from losing $1 million, okay? Or any loss, really. So the first thing he advises is, first, if you're going to be in the market, if you're going to be a participant in the market, you need to figure out what type of participant you are. A lot of people are just doing it. I have not really spent a lot of time to actually think about what exactly am I doing here. And so he says that there are 5 types of participants in the market. The first thing you have to do is figure out which of these 5 are you. The first one is an investor. An investor is someone who parts with their capital with the expectation that this capital is going to earn them money. For example, interest or rent. So somebody that buys a property and charges tenants over the long run and is banking on making money from the rent that they pay them, or when you buy bonds and the interest that comes from it. So this is an investor. An investor has a very long time horizon. They're looking at things over the long run. They're not looking to get their capital anytime soon. The second activity or participants is trading or traders. These are people who are trying to extract the gains from the differences in the bid and ask price of stocks. This changes by the minute. There's a lot of fluctuations there, and there are people who it is their job to try to capitalize on this fluctuation. Third one is speculating. Speculators are people who part with their capital, speculating and expecting that their capital is going to appreciate. And once it appreciates, they're going to try to get their capital back. So they don't have as long of a time frame as investors. So this will be somebody who buys a property expecting, speculating and hoping that the value of the property goes up. Soon after it goes up, he or she sells the property and gets the money back. The third one is betting. So bettors are people who make a call on something. Like when you bet on something, you're betting that you'll be right. And you and the person that you're betting with, you kind of have an agreement that if I'm right, I get money. If I'm wrong, you get to keep the money. So to me, this is what happens with options. That's what I thought of. Remind you, I'm not a guru. So just keep that in mind. Take all I'm saying with a grain of salt. And then finally is gambling. Gambling is an extension of the betting, except that gamblers are more motivated by entertainment. There's not much of a rhyme or reason to what they're doing. They're just there for fun. They're there for the excitement, and they kind of go with their emotions a lot of times. I feel like the more methodologic you get with your gambling, then you start moving in towards being a bettor. Okay, so these are the 5 things that are going on. Now, I don't think these are things that are mutually exclusive. I think you can be doing more than one of these at the same time. In fact, I think a lot of people that are participating in the market do more than one of these things at the same time. But his point here is that you have to understand what is happening in the market and understand what you are doing and what you want to do. Have a clear and good understanding of exactly what you're doing with your time and your resources. After you've done that, you come up with a plan that is congruent with the kind of participant that you are. You have to do some research, develop some tools that will help you come up with a plan. This plan is going to tell you exactly how you are going to engage in the market. It's going to tell you when you're going to act and when you're going to not act, when you're going to enter and when you're going to exit, when you're going to buy and when you're going to sell. You want to be analytical and put some forethought towards your actions and not just go with the flow. Don't go with the crowd. Don't go with your ego. Go with the plan. So first thing, what kind of participant are you? The second thing is develop a plan. And the third thing is to stick to your plan. Have the discipline to stick to your plan no matter what's going on. In the heat of the moment, it's very hard to stick to the plan that you drew up. Sometimes it looks like, man, things are going too good and your plan is telling you to chill, but things look like they're going too good. It takes discipline to tell yourself, no, I'm going to chill. And sometimes still things are going bad and you want to jump ship and your plan says, no, it's not quite time to jump ship. So it takes discipline to stay the course and do what you're supposed to do. Your plan can get some fine tuning over time, but it's important that you have that plan and you always have a plan on what you're doing. This is the things that you should do. Now, the reason why people lose money, according to him, there are 2 reasons. Number 1 is you did not have the right tools or the right analysis. The analysis that you're making of the market, the tools that you have developed for yourself, with which you're going to use to judge the market and read the market, are wrong. You just don't have the right tools to accurately decipher what's happening. So therefore, you're not going to make the right decision. Number 2 is that people don't stick to their plans. Like I said, you have to have the discipline to stick to their plans. There are a couple of reasons why people don't stick to their plan. One of them is ego. Sometimes people personalize failures and personalize losses. It's important to not personalize any of these. If you're winning, if you're doing great, don't start thinking that you're better than others or that you're so awesome. Don't start thinking you're infallible. But if you're losing, don't personalize that either. Again, stick to your plan. Essentially, those are the 2 reasons, and those are the 2 reasons that made him lose money. Number 1, not having a plan or a good enough plan, and 2, not sticking to your plan. It's pretty simple, right? Pretty straightforward. But I have to share with you some other thing. Now, Jim Paul is a trader. I mean, this was his career, so he believes in trading and all that things. There is a quote-unquote open secret that it's almost impossible to, in the long run, have a net profit with trading. If you are a trader, I would like for you to share with us your experiences. Well, I'm not a trader, but I'm curious as to what other people think out there. If you are a trader, let us know your experiences. If you have watched this video up to this point, I have to say thank you. And please don't forget to like, comment, and subscribe. In your comments, share with us what you think about the book and share with us what you think about what I have shared. Let me know what book you're reading currently. And until next time, keep reading and keep gisting, okay? Nos vemos. Adios. Jesus, that was hot.